Scott Rostan, who's the president of Training the Street. And Scott is a former M&A banker at Merrill Lynch and also an expert on valuations for M&A and IPOs. And he joins us from our New York bureau this morning. Good to have you with us, Scott. So some are questioning the timing. I mean, this is the world's biggest commodities trader. Are they signaling that when they're ready to sell shares to the public, that the peak of the commodity cycle is done?
That's a good question. I think that's always the timing of the market and selling shares is on the forefront of people's minds. But I think it's important to realize, this company's been private for so long. It's the largest in the world, and there was still a very strong demand. I mean, $11 billion U.S. So in many ways, you can measure this as successful. The aftermarket trading has been soft, but it's very difficult to time the market highs and lows.
Yeah, let me ask you about the pricing itself of this IPO, because in a lot of news stories, they were saying that Glencore chose the mid-price of its indicated price range for its IPO, but some are saying that it's sold too high, considering you're seeing declines for the stock after its debut.
Yeah, and the market chatter has definitely been that it was a rich valuation. You hear a lot of people saying it was a full valuation. The aftermarket trading, as you've seen in London for the last few days, and as we anticipate with the pre-opening here in Hong Kong, I think the market is just trying to wait and see and figure out where it's all settling. Remember also, they haven't really had a full snapshot of the company's fundamentals, and so let's see what their next earnings comes out with and how the company under the public spotlight as a public company and that scrutiny, how they perform and trade when it can then shift more to the actual underlying fundamentals of the core businesses.
Okay, let me ask you about the month of May, because according to the old age adage, of course, you sell in May, you go away. But, that's not deterring companies. A lot of companies rushing in to list on the market. So what does that say to you about the year's outlook on stocks? Is this the high point right now?
A lot of deal-making activity, whether it's IPO or debt or M&A, is a lot about momentum and a lot about psychology and investor sentiment moving forward. So as you saw with LinkedIn last week and Yandex today, there's a lot of fervor for especially internet social media stocks. I think a lot of companies are going to see that window of opportunity and want to seize on it. Obviously, they want to sell high, and investors want to make sure they're getting a fair price. But ultimately, there is a window of opportunity. With the trouble in Europe and the debt crisis, and the uncertainties with commodity pricing, and maybe this is the end of or temporary of a bull run. Companies do want to rush to raise the capital, and they want to make sure they're accessing the markets at an opportune time.
Well, speaking of mispricing, you're talking about these social networking sites, these internet sites pricing high, but look at the surge on day one. Maybe they underpriced their shares.
And that's literally the million-dollar question, or in this case, tens of million-dollar question. That's a tough one to answer because the underwriters and the company itself are trying to balance a lot of things. Yes, they want to have a fair enough price where they are getting investors excited about the stock, but on the flip side, they want to make sure that they're raising as much capital as possible. Remember also that you also have to look at the supply and demand, and LinkedIn's a beautiful illustration of this. People are clamoring for social media, and everybody wants a Facebook or a Groupon, and those obviously are coming down the pipeline. So getting their hands on LinkedIn, there's going to be a lot of fervor when such a small free float with so few shares trading. Of course, you're going to see a frenzy around that. I don't think anybody anticipated such a frenzy, but it's not unusual given the hype around this type of company. But again, let's see where the fundamentals kick in. Time will tell. When more short shares are floated, when other investors can sell, you might see the stock come back to earth, but then again, you might see it to rocket and take off.
That's right. Scott, one more question for you. What do you think about the fervor to buy into these Chinese internet stocks? Some of them still aren't making cash or a profit, but you still see these huge valuations and people piling in.
And a lot of people, and I was talking in class the other day about this, it feels a lot like 1999 with the dot-com bubble, part two. A lot of people using the word bubble, and they say it a lot of ways of and bringing up the dot-com. Maybe this is another bubble with it, but again, a lot of times investors are getting in on the IPO market. They're looking for growth. They're looking for a momentum. They're looking for the next hot thing. And obviously, anything related to China, internet, social media is going to be very exciting. Is going to get people's attention. And so you have to then, but you also have to look at each company on an individual basis. Every story is very local. And how's this company going to perform? How well are they positioned? A company like LinkedIn, a company like Yandex, extremely well positioned. So of course, you're going to see a lot of investors excited about the stocks.
All right, Scott, thanks for joining us this morning. Great insights. Scott Rostan, president and founder of Training the Street, joining us from New York.